Hi, welcome to this podcast where I'm going to look at the limitations of financial information. It pretty much applies to anybody who is studying any form of accounting. And we're looking at both some of the information to do with just looking at the accounts themselves, and it also is very relevant to anybody who's studying any kinds of ratios, whether it's profitability ratios, liquidity ratios, or indeed investment ratios. Okay, people are going to use financial information. They're called interested parties, or you'll also hear them called stakeholders. Interested parties is a more modern name for stakeholders used by some people. So we're looking at things like managers, directors, banks and lenders, customers, suppliers, owners or shareholders if it's a limited company, potential investors, employees, governments, and the local communities. And all these people are going to use the accounts to try and predominantly predict what's going to happen in the future. So, for example, for a bank or a lender, they're going to be looking to see whether it's likely that in the future this business is going to be able to pay interest on its loans and ultimately pay back loans. For shareholders and potential investors, they're going to be interested about the likelihood of growth and whether that's going to mean that the value of their investments in the company is going to go up, and also whether they're going to be able to pay them a return as drawings or as dividends. Employees are interested to see whether they're still going to have a job in the future. And the big people that do look at it retrospectively are the government, because they will use the information to decide how much taxes are going to get paid by the business. But they will also be interested in what's going to happen with this business and more globally with the industries within which it operates into the future. Obviously, managers and directors, they are going to use this information to try and plan a better use of resources in the future and to plan so that the business can continue to expand, grow, and make more profit. So all these people have got a lot of interest in the accounts of a business. One of the things you've got to understand, if we're going to use financial information, there are lots of things contained or that happen within a business that aren't just determined by straightforward profit loss, revenue, the value of the non-current assets, but have got, if we like, intangible factors to them that we can't put a monetary value on them. So we need to know these and be able to sort of explain them in an examination. Okay, one of the first biggest problems with all financial information is it's what we call retrospective. It's backward looking. So, for example, a big limited company will normally file its accounts within 6 months of their financial year ending. But what that tells us is what happened 6 months ago. And it's between 6 months ago and 18 months ago. And if you think about just before those accounts are published, the most recent information that we may have on a company might be well over a year old. So we don't know what's happening today from financial accounts, and therefore from the ratios that we use from them. We know what was happening 6 months ago, or possibly almost 18 months ago. The other thing with accounts is it only contains quantitative information, that's figures, and in fact in accounts it's figures that we can put a monetary value on. There are lots of things that also affect the performance of a business that it's very hard to put an accurate figure on. These are called qualitative factors. So it's things like how good are the staff of one business compared to another business. So if I was trying to compare Apple with Samsung and also look at what I thought was going to happen to their profits in the future, I'd want to know how good the staff are. Are they able to manufacture and develop better new phones in the future than the competition? What new products have they got coming out? And are those products going to be successful? And again, so that's something that ultimately, if I was an investor, I'd have to make a judgment call on. The quality of the management. Does one company have better managers than the other? The company, what you would expect is that in the future, business with a better management team, you would hope would be able to deliver better results in the future. It doesn't tell you about unique locations. So, for example, I may have a large shop very close to a new housing development, well, that's obviously going to be a big benefit to me compared to somebody who hasn't if I'm selling vegetables, because there's going to be shortly a lot more people coming to that location. It doesn't tell me about the morale of my workforce. Have I just made lots of people redundant? Are people optimistic about the future of a company? And also, financial information from the accounts and the ratios that we make from them doesn't tell me about any emerging factors in the economy. For example, as I'm making this podcast, coronavirus is increasing quite quickly in the country I'm in, and there has been a marked slowdown in the number of people going to places like Starbucks, to shopping malls, and to restaurants. A shopping mall may have had great figures up until 2 weeks ago, but the one thing that we do know, the shops in there are suffering a significant decline in the number of sales. Okay, there are a lot of difficulties as well in comparing firms and even time periods. If you're comparing firms, different size firms do have different built-in costs to them. So, for example, if you've got two shops that are in similar sized premises, the one which has got the larger customer base is going to have a lot less rent per pound of sales than one which is relatively new and only has a small customer base at the moment. So cost of sales are much likely to be lower in the business which has got the larger established customer base. It's obviously ridiculous to try and compare, for example, a large international grocery chain like Walmart with a local corner shop or Bacala, which is just a completely different business. It's incredibly difficult as well to compare firms in different markets or industries. Something like a supermarket chain like Walmart, for example, has a strategy of buying things and putting a small markup on them, but trying to get large volume. Somebody like Apple, which looks at innovation and trying to bring out unique products, they're going to spend a lot of money on R&D, but fundamentally when they manufacture something, they are going to make a large markup or a lot of profit compared to the purchase price, the manufacturing price of those goods. And also firms might have different policies how they account for things like depreciation. Depreciation is the fall in the value of your non-current assets over time. So for example, it's obvious that a car is going to fall in value from year 1 to year 5, but how we do that is going to be different from one firm to another firm. And also, if we want to look at the assets, for example, the non-current assets that a firm owns, well, if you think about, for example, land's gone up in value an awful lot over the last 100 years. So you could look at a company that was founded 100 years ago and bought the land for what we would consider to be a very, very small amount, and compare it to a new company which has bought the land relatively recently, and in their accounts, it would be a vast difference in the value of that land, even though it could be the same land literally sitting next door to one another with the same current market value if we were to try to sell it to somebody else. Okay, and then we've also got a final one, which is inflation. This really more affects the ability to compare firms over time, because this is an important thing to do. As an investor or as a manager, you'd want to be seeing growth in profits over time. You'd want to be seeing growth in sales revenue over time, because this points to a business that's going to generate more profit in the future. One of the things we've got to discount from that is something called inflation. Inflation is the decline in value of money over time. So we're all used to the fact that we do end up commonly paying a little bit more for things from one year to the next. There have been periods where those changes in the price of goods have been noticeable within a day, where, for example, goods have doubled in price during the course of a 24-hour period. And what that does, it makes it difficult to compare time periods, because I look back to when I was young, and I'm sure you all experienced this. When I was 7 or 8 and my teeth were falling out and being replaced by my adult teeth, my parents gave me 5 pence per tooth. I've got twin brothers and sisters who are 3 years younger than me, and they were fortunate, so I thought at the time, insofar as they got 10 pence per tooth. And I've got a younger brother who's 7 years younger than me, and he got it really good, and he got 20 pence for every tooth that fell out. Now, the reality is that my 5 pence would buy me as many sweets, which probably isn't ideal for teeth falling out, when I got them, as when my youngest brother got 20 pence a tooth. So that's the effect of inflation. What you can buy with your money, well, that declines. Okay, thank you for taking attention, and I hope this was useful.